Hey all, welcome to ShareTreck. This is Raj here. Friends, I hope your holidays are going really well and I hope you're all well primed for the market. Earlier, in my first video of this series, I had spoken about BLS data reliability and higher for longer interest rate and contrasted that with the high price to earnings multiples of our Mag 5 stocks as two major risks. Today I'm going to talk about the underlying forces at play in the cloud and AI segment that our Mag 7 dominates. As you guys know, Mag 7 disproportionately leads the market and pulls the index. Any fragility in this area is a huge risk factor, and that's what I'm going to talk about today. I will disclose industry trends, examples and stats to back up my conclusions. And at the end, as always, I look forward to your comments and your feedback to get an idea of how you look at this situation. We are a retail investor channel and we share information with each other and improve our ability to deal in the market and get better outcomes. So please do not hesitate to like, subscribe and put your comments and interact here. With that said, let's get started. Welcome back, friends. Just months ago, we watched cloud revenues drive the Magnificent Seven's astronomical valuations. Amazon's web services, Microsoft Azure, and Google Cloud painted a picture of unstoppable growth. The market cheered as cloud spending hit $600 billion in 2023. But the narrative has shifted dramatically. All investments now dominate the conversation, with the Magnificent Seven pouring over $250 billion into AI infrastructure for 2023 to 2024 alone. Meta's pledging $30 billion, Microsoft's investment of around $10 billion in OpenAI, and Google's betting billions on Anthropic. That's what has been in the news. NVIDIA's data center revenue surged 409% year over year, and it reached around $18.1 billion in Q4 of 2023. Reflecting this massive AI spending and looking at how it has grown further in all of 2024, it seems that it's an unstoppable force at play. However, beneath this AI euphoria is a concerning trend that is emerging. Major enterprises are quietly abandoning the cloud. GEICO is an example. GEICO's dramatic exit from cloud saved them over $100 million. Dropbox clawed back $75 million annually through cloud repatriation. Even smaller players like 37 Signals reported 50% cost reductions after leaving AWS or Amazon Web Services. This isn't just cost cutting, it's a paradigm shift. Companies are moving into hybrid or micro cloud models, and also individuals are getting into their own personal cloud. At play is the fact that hardware is becoming cheaper and cloud subscriptions are getting expensive. Many individual users are buying NAS devices to convert them to personal cloud so that companies like Apple with iCloud may find the revenue growth slowing. So I have seen many YouTube videos where they teach you how to use a 3 or 4 terabyte NAS storage device to become your personal cloud so that you don't have to keep on paying Apple or Microsoft for cloud storage of all your pictures on your cell phone. So that trend is also growing. Then the question becomes, what does this mean for the future? So if we were to look ahead to 2025, I think there are two critical factors that emerge. First, these massive AI investments must begin showing returns. And given the fact that the investments were massive, the returns have got to be significant so that they can register in the earnings report. The market won't indefinitely support companies spending billions on speculative AI projects. The valuation of these AI companies are based on a high earning expectation. NVIDIA is a beneficiary of Microsoft, Google, Meta, and Amazon, and other majors buying a lot of H100 and then H200. There's a lot of improvement in performance from H100 to H200, and now they are getting into Blackwell, which has got significantly improved performance. These massive investments by the companies have pushed NVIDIA share prices very high, and these companies now have to start monetizing. NVIDIA itself has a huge profit margin, even if you compare it to its nearest competitor, AMD. These companies now have to start monetizing AI in a big way, and the consumers have to buy it, otherwise margins will decline and that will impact pricing. Now let me ask you a question and you can think about this. How many of you have actually subscribed to ChatGPT or Gemini or Claude or any other AI chatbot or anything like that? I personally use all the AI LLMs that I can find. For example, in order to research and put this segment together, I started off with all my ideas and concepts, and I did a lot of Google search to get information to build on those concepts, and then I had my text ready, and then I went into ChatGPT and asked it to help the flow of thought and presentation. And what I find is that if ChatGPT says that I've exhausted my tokens in my free plan, I just copy and paste that into Gemini and continue my work. And if Gemini is done, I go into Claude and continue doing my work. I don't see any problems, and I don't know how many people among all the user base is going to actually pay for those subscription right now. They may eventually pay, but not right now. And if you have the latest Apple iPhone, then ChatGPT is free for you out there. It comes as a built-in system, and you don't have any monthly subscriptions out there. So there are other ways in which users might be able to get the job done with LLMs. How many of them are actually going to subscribe? That is a big question I want you guys to comment about in the comment section, because this is where we have to crowdsource our understanding of how the market is behaving. Next question is, will big companies that are not in IT start consuming artificial intelligence? When I say big companies not in IT, I'm talking about logistics companies which are transporting materials from one place to another. I'm talking about fast food companies like RBI or people who own McDonald's. Are they going to start using AI in a meaningful way in their business? Is Target going to start using AI in a meaningful way? So that's what I'm talking about. And will they pay for it? In the case of Microsoft, I think Microsoft has a natural advantage with Copilot that comes with its Office subscription at both individual and corporate level. So Microsoft is able to penetrate the market immediately. It can convert its legacy market into AI market. It just needs the consumers to start appreciating that they now have AI capability in the suite of software that they are subscribing for. And later on, Microsoft can start improving the price and modifying the offerings to become more AI oriented. So Microsoft, I think, has an advantage. The question is, can Microsoft be able to increase its revenues due to the AI component, or is the AI component going to be subsidized by the Office revenue for a longer period of time? What about Google and Meta? How will they monetize their AI investments? Whatever Microsoft has got in a paid version, Google has got in the free version, like Google Notes, Google Spreadsheet, and Google Word, those kind of things. So Google Word processor. And they can bundle Gemini along with that. But the question is, when will people start paying for it? Second, and perhaps more concerning, is that the cloud revenue, which was driving all the Mag 7 shares to a particular level, after which the focus shifted to AI and it drew it further up. Now, this cloud revenue could significantly decelerate as more companies optimize or exit cloud services. We already spoke about the case of GEICO Insurance and a few other companies. Most IT managers will now be facing the question of whether to move out of cloud and save money or stay in cloud. This was not a question before, because the whole bandwagon was moving towards cloud. Now, every IT manager is going to be asked, why did GEICO move out of cloud? And if they were able to save 300 million, is that a case for us? How much can we save? And what do we need to do to move away from the cloud? So that question is going to come. That will then depend on their application and architecture that they have done. So we'll have to watch for some weakness in cloud revenue. But right now, cloud revenue is what is driving. And if you recollect earlier, I was looking at various IT companies and Mag 7 companies, and I was remarking that their cloud revenue is growing, so their valuation is there. So is the cloud revenue going to go down? Not only because of attrition, like people moving from public cloud into hybrid or private clouds, but also because there is a lot of competition and the cloud subscription prices are going down in order to retain customers. So we'll have to look at the margin erosion out there in the Mag 7s. And the point to note here is that now there is conversation about whether staying in the cloud bandwagon is worth it. This could mean headwinds for cloud revenue going forward, which indirectly translates into a situation where not only is the cloud revenue not supposed to grow in order to maintain the value. We have the question of whether AI is going to monetize, and we have the specter that the cloud revenue, instead of growing, is going to start coming down. So the earnings that are going to come up in the first quarter of 2025 is going to be very, very significant, and that's where I see a whole lot of risks. Cloud cost paradox is the way I look at it, especially in the AI era. Traditional cloud benefits are breaking down under AI workloads. So that's the reason why I think there's going to be a rethink. A single H100 GPU instance costs $15,000 to $20,000 per month on major clouds. Training large language models requires 400 to 1,000 plus GPUs running continuously. Enterprise AI initiatives often see monthly cloud bills exceeding 1 million. The rise of specialized infrastructure providers is another factor that one has to contend with. GPU as a service players have emerged. For example, CoreWeave offers 10 to 30% lower costs versus major clouds. Lambda Labs reports 40 to 60% savings for AI workloads. And Foundry demonstrates 25 to 45% cost reductions for sustained usage. And then we have hybrid solution, co-location providers seeing 200% plus growth in AI infrastructure requests, enterprise grade GPU clusters showing 40 to 60% total cost of ownership improvement versus cloud custom solutions enabling predictable costs for sustained AI workloads. So that's the underlying dynamic that we are seeing emerge as we look closer into the patterns that are happening within this area of business. So now let us talk about the conclusions that I derive from this. Okay, I think that traditional cloud providers will be losing high-value AI workloads. New providers will start capturing 30 to 40% of new AI infrastructure spending. Enterprises adopting multi-vendor strategies for cost optimization will be the feature going forward. And I think sustained usage will be a key economic driver. AI workloads typically run 24/7, eliminating cloud's elasticity benefits. Fixed infrastructure becomes more cost effective at greater than 70% utilization. And then we also have to consider the scale effects. Large scale GPU deployments benefit from bulk hardware pricing. Specialized providers achieve better power efficiency and density. Direct hardware access enables higher utilization rates. This suggests there is going to be a shift, a fundamental restructuring of enterprise AI infrastructures, with specialized providers gaining market share through superior economics for AI-specific workloads. The trend challenges the dominance of traditional cloud providers in the emerging AI economy. Unlike traditional public clouds, these approaches are often built from the ground up to handle the unique demands of modern AI infrastructure. This means high-density GPU configuration, liquid cooling systems, and energy efficient designs will be more prevalent as we go ahead. More importantly, they allow enterprises to shift to ownership models or shared resources that cut costs over the long period of time. Considering the market implication, I would say that the Magnificent Seven trade at premium price to earnings multiple, largely justified by initially cloud growth and then by the AI potential. If either of these narrative falters, the AI investments don't yield results or cloud revenues decline, these valuations become harder to defend. For investors, this creates a precarious situation. The same companies dominating cloud services are now betting big on AI, while traditional cloud revenue base shows signs of erosion, with NVIDIA trading at 250% above its 2023 levels and tech valuations at historic high. The market may be underestimating these converging risks. That is my major fear. Remember, markets often shift violently when dominant narratives change. Keep these factors in mind as we navigate from 2024 into 2025. The AI revolution must deliver more than just promises, and it has to deliver soon. And friends, all these valuations have been built up based on the fact that the market is expecting great returns going forward in the AI sector. That's what the PE multiples are telling us. So fast forward into the next earnings season, which will happen in the first quarter of 2025. Are we going to see superlative numbers coming out in earnings of companies like Google, Meta, Apple, Tesla, and all these companies? we have to think about that very carefully. And if you feel that there is a risk that expectations may not be met there, then we have people who have put a lot of money through margins and other measures in order to bring the price so high. And right now there is a buyer fatigue, I think, because we are seeing many, the broad-based rally is not there. There are many companies that are declining. Mag 7 is what is leading the market. So I'm thinking that when the drop comes in, it will be sharp. So I've heard elsewhere that Tom Lee is saying that the first half of 2025 may not be that great, but the second half is going to be fantastic. So probably we should gear up for a little bit of profit taking, a little bit of risk resetting and setting a new floor. And from there we start going up again, because by then the earnings would have come out and we'll be able to see how things are panning out for the AI sector. So we have to watch out for those things. And also remember there's going to be a new government coming in and they have got a totally different approach towards everything. And we'll have to see how that plays out, how many of their promises they deliver. And as I mentioned, I'm still working on a video which is going to talk exactly about each of those proposals. The first one is doing the 2 trillion tax cut. The second one is the Doge effort to downsize the government, and so on and so forth. I'm going to talk about all of those in the next video, but I would like to hear from you guys. Do you think the AI hype is overblown? Do you think the earnings that will come up in the first quarter of 2025 will justify all the enthusiasm that the market has shown that is reflected in the price to earnings ratio today? Remember, Tesla and Palantir are valued so high in terms of price to earnings that it's absolutely crazy. And if you look at Meta, and if you look at Microsoft, Apple and all, their multiples are also high, but they're not as crazy high as Tesla and Palantir. So if we are at that level and there is no more buyers available to push the price higher, and then we get weak earnings, can you imagine what would happen? So that's what I'm worried about, and I want to hear from you guys. Please put it in the comment section. Do you think I'm worrying about something that's a nothing burger, or do you think that there is some merit in what I'm talking about? Give me your thoughts, give me your original thoughts, even if you have heard it somewhere else in some other channel or something, but if it made sense to you, I want to hear it from you in the comment section. So with that, I would like to bring this video to an end, and I wish you all a very happy holiday season. Please enjoy your time and be safe in the market. Bye for now.